Hello, fellow Rebel Capitals. Hope you're well. I am back with my good buddy, Bob Murphy, and we are here to talk about what has been happening with the United States dollar crashing and interest rates going up at the long end of the curve. Not exactly what you would expect with the volatility that we see in the stock market. And maybe more importantly, how you can understand the mechanics here better to determine what is likely to happen in the future throughout the rest of 2025. So Bob, thanks a lot for coming on, buddy, on such short notice to talk about what is actually a pretty complex issue.
Yeah, I agree. And I will say, I'll go ahead and let you maybe set the table a little bit more for your listeners here, George. But looking at the numbers, I have a much more reserved take than I did when you first asked me to do this. I had kind of thought I knew what was going on, but the more I looked at the play-by-play and the way the numbers were moving, I'm not as sure that it's the narrative that people are saying.
Yeah, but that's why I like to have these conversations with people like you, because number one, you're a real smart guy. Obviously, you've got a PhD in economics, but probably more importantly, you're very open-minded, and your number one priority is to seek the truth. You don't have some political bias, or even though you're libertarian, you don't have a political bias. I mean, if the data takes you in one direction, that's the direction you're going to go, regardless of what you think it should be. And so that's one of the reasons why I've got so much respect for you. And that's why I like to have these conversations with people like you. So what's been happening with the United States dollar is not the fact that it's just down at 99.5 on the DXY. That's no big deal. In fact, historically, that's actually pretty high. What's really dramatic is the move that we have seen and how fast the dollar has gone down. So we look at stock market moves of 5% or 6%. And although that's uncommon, we see, it just happens every once in a while. You get a bit of a downturn or something like that. But to see a down move in the United States dollar, let's just say 2% in one day, which is what we saw that is extremely rare, especially when you see the stock market selling off. And you would think that people would be going into dollars because of a need for security. It's safe, liquid asset, and it's a flight to safety, as they say. So when you combine that with the unusual fact that treasury yields are selling off, and the thing that you would expect the opposite of, it begs the question, are foreigners just dumping dollars? Are foreigners dumping treasuries? Are they dumping dollars? And the process and how this would work, guys, is let's just say that you're a pension fund manager in Europe and you don't like what Donald Trump is doing. You don't like the tariffs. You think the United States is going down the toilet. So you're like, screw this. I've got all these treasuries. I'm going to go ahead and sell them. Then I'm going to take the dollars. I'm going to go into the FX market. Then I'm going to buy euros with those dollars. And then I'm going to take those euros and then I'm going to buy German bunds. And if that happened in isolation, what would happen is the treasury yields would go up and the dollar would actually go down. So, and this is kind of the narrative that we're seeing on Twitter right now. So that's kind of what I wanted to think through with you today, Bob.
Okay, great. Yeah, and thanks for that. And I appreciate the kind remarks. And I'm hoping I'm living up here to your statement, your description of me, because I came in with, like you say, with the narrative, and also given the people I follow on social media and whatever, that there's a lot of accounts I followed that they would just love it if, finally the dollar's dead, and just like we've been saying, and the bond markets are collapsing.
Come on, it's Peter. It's Peter.
Well, there's a lot that subscribe to that, and especially too with gold.
To be clear, Peter's a very good friend of both of ours, but he's the main cheerleader,
right? And gold blowing up and everything, so it all kind of fit. But let me just quickly, before we just get into the more general kind of conversation here, but the specifics of when, like I say, I was just kind of cribbing and jotting down some notes for this. So the stock market, went down from April 2nd to April 4th. Looking at the close, the S&P was down a cumulative 11%. Oh, and then when Trump, announces the pause, going from the close of April 8th to April 9th, when the news came out on the 9th about the 90-day pause, the market was up, by which I mean the S&P 500, about 10% just in that one-day shift. So that kind of fits the narrative that, the tariff scared the crap out of everybody. Then when he relented, the market recovers. Okay, fair enough. But the 10-year yield stuff, just looking at that, it was at 4.2 on April 2nd, so-called Liberation Day, and then it dropped to 4.01, and then, which is,
Friday it was down like it was below 3.9 intraday.
Okay, sure. Yeah, I'm just looking at, I guess these are probably closing values. And then, you know, so it's going down what you would expect in terms of, oh yeah, the market's panicking, but people aren't doubting the solvency of the U.S. Treasury, you know, that kind of stated narrative. But then I think where people started freaking out, and then certainly what the speculation was, and Trump even said things to this effect about it was the bond market that finally made him blink, and why he, you know, really he did a Trumpian, oh, the markets were getting yippy, so I, you know, threw him a bone, that kind of deal. But it was on April 7th, it jumped up to 4.15, and then April 8th to 4.26, and then April 9th, it was 4.34. And then now it's, you know, the last I checked right now, it's like at 4.4%. Again, talking about the 10-year. And the narrative, I just grabbed an example. There was a political article talking about, you know, bond market forcing Trump's hand or something. And there was a phrase in there that said, the 90-day pause has done little to quell the market's fears. Mm-hmm. And so, again, if I, being a perma-bear Austrian libertarian guy who hates the U.S. government, right, I would love to go along with that. But I was like, well, wait a minute. The stock market rebounding, the narrative was, yeah, that showed how dumb Trump was. And so when he dialed back what he was going to do, the market rebounded. So by the same token, if falling interest rates normally mean there's going to be a bad market, and then Trump relents and now interest rates are going up, that by itself doesn't mean, you know, that could just mean, oh yeah, now the market's not as scared as they were before he gave the 90-day pause. So you see what I'm saying? That
yeah,
I'm saying
can't have your cake and eat it too.
Yeah, that's what that
rates are going up because the stock market's going down. Well, then they can't go up.
Right.
Because the stock market's
So
going
again,
up.
it could all be considered. Like I say, you know, there was that brief period where they were going, you know, the market was still tanking and the 10-year started going up a little bit. But I'm saying it was really only a 2-day stretch where yields were rising before, you know, the market Armageddon or carnage, let's call it, had happened from the initial shock of the quote Liberation Day and all that stuff, and people discussing it like, wait, this formula is just our trade deficit? Are you kidding me? You know, and all that kind of stuff. And then, you know, but there was really only 2 days where Treasury yields were rising when you wouldn't have thought. And so even there, you know, for all we know, maybe there was insider trade. You know, I'm just saying, if I were someone who thought, no, the U.S. Treasury's fine, or if I'm an MMT kind of guy, and no, they can just print money. Who care? You gold bugs or whatever, you're idiots. The U.S. Treasury's fine. They're not going to default ever. I'm saying, looking at the bond market in isolation, it's not the slam dunk I thought it was. Because again, and one last thing I'll say here, George, is right now, again, I just checked before we started recording, the 10-year's around 4.4%. All you have to do is go back to February 21st. And prior to that, the 10-year was above 4.4. Yeah. So it's not like, nobody was.
The yield curve is still flat with that, right? I mean, the Fed funds at 4.3.
So anyway, I'm just saying it's not as like from the news coverage and whatever. Before I actually looked at the charts, I kind of had this idea that 10-year yields were going through the roof and this was crazy. And I'm saying it kind of is. Again, there's like a 48-hour lag where, yeah, you could say that's a little bit weird. But other than that, and then just on the dollar stuff, what's interesting there is, in terms of textbook theory, the U.S. raising tariff rates should make the dollar strengthen. That might be counterintuitive to people, but that's kind of that, Americans don't want to buy as many foreign goods, and so there's fewer dollars chasing foreign currencies. That makes the dollar strengthen. And that's also why the standard textbook stuff says raising tariffs by itself doesn't do much to, quote, improve your trade balance, because, it hurts imports, but it also hurts exports because your currency strengthens, so it's harder to export. But so that's why when the dollar was tanking in response to this, it was an open question as why is that happening? So one thing is just, fearing retaliation. Another theory was technically Trump gave like a week window as to when, the rates were actually going to kick in from the announcement. So maybe there was a rush to import. I don't think that's what it was, but theoretically that could have been it. And then the other thing is just, because this was such a dumb move, people thought the U.S. market was going to get crushed. And then a lot of foreigners in general don't want to be in U.S. assets, or maybe for the reason you're saying, just, geopolitical or whatever. And so now there's, foreign currencies don't have the same incentive to chase dollars, and that could be why the dollar fell. But anyway, I'm just saying that was interesting, that normally you'd think by itself a large tariff rate hike should have made the dollar strengthen. And so the fact that it crushed it is interesting. Yeah,
I think the first question I would have there is, because what they're referring to is a trade deficit, really. So if the trade deficit shrinks and fewer dollars are leaving the United States, and if fewer dollars are leaving the United States, that should strengthen the dollar because there's less supply of dollars. The first thing I would do there is I would say, okay, well, maybe trade deficits don't matter as far as impacting the dollar. And so why would they not matter? In my view, they don't matter because it's really the Eurodollar system and the banks outside of the United States that really control the supply of dollars. So if we have liquidity drying up, then, I don't care how many dollars you pump outside the United States, it's really not going to move the needle. And if those banks outside the United States really don't need dollars to begin with, to create dollars or to settle interbank transactions, then the amount of dollars coming or going really shouldn't have that much of an impact, especially when you consider the amount of dollar debt and therefore dollars that was created by banks outside the United States. If you peg it at 75 trillion, you can see why a trade deficit of 100 billion really is just kind of a drop in the bucket. So that's kind of where I would go with that. It is just kind of questioning, and I'm not saying this is your view, but questioning that textbook economic view that the trade deficit actually impacts the dollar. Does it impact other currencies? I would say probably. I haven't done the research, but I would say probably. But that's because those other currencies aren't the global reserve currency, and therefore they are actually impacted by what the domestic economy does. Where because we're in let's call it $125 trillion global economy with $75 trillion of dollars that were created with debt outside the United States, I don't know that domestic policy really has anything to do with the value of the dollar relative to other fiat currencies.
Okay, I'm familiar with your views and I get what you're saying. Let me just make a distinction, and this is good because your crowd is very subtle and nuanced. I know that you're right. So one thing that the standard textbook economist would say is if a given country, forget global reserve currency, but just in general, some country, if they're running chronic trade deficits, you would think eventually that would make their currency weaken.
Yeah.
Such that the trade deficit would be self-reversing, right? That after a while, it's harder for their people to buy imports because their currency keeps getting weaker and weaker, and then their products get cheaper and cheaper to foreigners, so eventually they should export more. So it should be self-reversing, and that's why you would think if, under the classical gold standard or nowadays with countries besides the U.S., you're running chronic trade deficits, your currency should weaken. But that's not what I was saying. So that's the one thing you can quibble with. But I'm saying no. There's a different line of argument too that says, given that your country imposes high tariffs, then that shock should, make your people less willing to buy foreign goods, right? Because now they're artificially more expensive. And so that right there immediately, other things equal, makes your people try to, less willing to buy foreign items. So it's not the trade deficit weakens your currency. It's that the tariff strengthens your currency and then that reduces the trade deficit. Is the idea.
Or another way that reduces the tariff, because if we go back to 2008, and correct me if I'm wrong, I think this is the point you're getting at here. If we go back to 2018 and look at the tariffs that were put on China, one of the things that offset those tariffs was the simple fact the dollar went up. So what happens there is if you're a Chinese widget maker and your profits and most of your expenses are denominated in yuan, so all you're concerned about is how much you're selling your product for in yuan. So let's just say that Trump imposes a 100% tariff on your widget. Okay, but if the dollar goes up, let's just say by 200% or something like that, then you can go ahead and reduce the price of your widget to the point where the dollar price is still the exact same, but you're making the exact same amount of profit you want. Right. So what do you care? And so that basically, so why are we going to bring all this manufacturing back when it doesn't really impact the Chinese or the Malaysians or the Vietnamese or whatever, if the dollar is offsetting the tariff to begin with? Was that the point you're making?
Yes, that's a textbook. And you're right, George, that's why, for example, guys like Stephen Moran, who is the new head of the Council of Economic Advisors, that he was at Hudson Bay Capital, I think was his shop. That was one of the points he made. He had this long, 40-page white paper back in November about restructuring global trade flows in a age of fiat currency or something like that. And that was one of the key things. So there are a few guys he has a PhD in economics, right? So there are a few guys that are credentialed, and they're not just saying, trade is bad, protectionism good, U.S. jobs for the win. They're getting into the literature and that was one of the points he made, that there's this thing called optimal tariff theory. And so yes, to the extent that a country is a large share of the global demand for a product, when their government imposes a tariff, so long as it's not ludicrously high, part of the cost of it. Yeah, it turns up as higher prices to their consumers, but to the extent their currency appreciates, it kind of offsets that, like you're saying. And so in effect, foreigners eat some of it. It's no different like if the government puts a sales tax on a product, it's not necessarily 100% borne by the consumer. The producers might end up lowering the sticker price a little bit, and then kind of splitting the burden that way. So anyway,
they don't even split the burden. In this case, they don't even split the burden because their expenses are denominated in a currency that's going down against the currency that they're pricing their goods in.
Well, sure, but the point is, at the point of entry into the U.S. ports, if the U.S. government's taking a new 25% cut, somebody's got to eat that. And so Moran's point was it could end up flowing back partially to the foreign producers are willing to accept a little bit of a haircut in the consumer. But
the point, Chinese widget maker will drop their price.
Yes,
they will drop but they're dropping their price in dollars. So if the dollar is appreciating against the yuan, then that doesn't necessarily impact their yuan cash flow.
Okay, sure. So any event, that his point was to confirm what you're saying, that wouldn't, to the extent that currency appreciation happens, it doesn't make U.S. jobs go up because it's still the foreigners doing it. But he was saying, but at least we get the revenue. So he was trying to cast it as either way, it's good because either we get more tax revenue or consumers really do shift to domestic and we get more U.S. jobs. So anyway, but regardless of that, that's the argument. And like you say, that seemed to have been the case before. This time around, it didn't because the dollar tanked. And so it's a question why. My guess is because it was so aggressive, they feared people thought there's going to be retaliatory tariffs. But in general, just, that was such an aggressive move that it made people kind of reevaluate, do I want to be owning a portfolio of U.S. assets right now? If the Trump administration is going to do that, who the heck knows what they're going to do next month?
Yeah, so let's get into that. Okay. So let's get into the mechanics of foreigners dumping U.S. treasuries or just dumping dollars, because this is the main argument that you're hearing on Twitter and kind of in the mainstream media, and how that would impact the dollar. Because you and I have discussed this, and I think it's your view, maybe it's changed a bit, that would negatively impact the dollar. And my view is that over the short term it might, but over the midterm, that it would snap right back, or it would likely snap right back to where it was, especially if this was happening in an environment where liquidity was extremely low. So the way I discussed this the other day on a whiteboard is I set up two foreigners. One foreigner, his balance sheet, I called him Foreigner Frank. His balance sheet had all USD assets to treasuries, and he had no USD debt, none. And then you had Foreigner Fred that just had, let's say, yuan assets or something like that. But he had USD debt. He was the guy that borrowed the dollars or made the loan with the bank to create the dollars to begin with that, let's just say, Foreigner Frank has on his balance sheet. Mm-hmm. So what I think the argument here is that if Foreigner Frank is sitting there dumping these treasuries, what he's doing is and that's going to make, all else being equal, the treasury price go down, the yield go up. So then he's taking those dollars, but he doesn't want the dollars because he hates Trump or whatever it is. He's dumping the dollars. He doesn't want them. So he takes those dollars, he sells them into the FX market to get euros, because his end game is he actually wants euro denominated assets. Let's just say in this hypothetical. So then he sells dollars. So, okay, that increases the supply of dollars that are out there circulating, and therefore the dollar goes down. So if we're looking at the foreigners dumping, U.S. assets or dollars in terms of a guy who has no dollar denominated debt, then it makes sense why the dollar would continue to go down, would go to, 99, 95, who knows where it ends, all the way at 70, or the dollar quote unquote crashes. But my point is I like to look at it from the standpoint of the other guy that has the debt, because that is a constant bid. I think Lynn calls it an inelastic bid for dollars. It's always there. And with the debt being very short term that created that loan to begin with, then what Fred has to do is he has to figure out how to get those dollars. Mm-hmm. He has to have them in order to make his payments. If he doesn't, if he defaults, and then all the dollars go away, because all the dollars are a liability of a commercial bank, right? So I look at it through the standpoint of Fred, and if you got Frank over here dumping all of these dollars, well, Fred has to collect them somehow because he has to pay this debt. And then you say, well, he could roll over the debt, but in a low liquidity environment, the bank is going to be less willing to do that. So let's just say that he has to make this full payment in 30 days. Within that 30-day period, you can see the dollar go down quite significantly because you've got that time mismatch. But once you get to that 30-day point, that's when it's time to pay the fiddler. And then that's when you have to collect all of those dollars that the other guy was selling. And then you're paying down the debt, which, as you know, reduces the supply of dollars even further. So because we're not creating more dollars to the banking system because liquidity is tight, because risk is high. So I guess my point here is I want to think through with you and get your view on why the dollar would go down if foreigners are dumping, and then maybe have you critique my view on why the dollar might go back up because of the constant bid from that dollar denominated debt.
Okay, so we're in agreement on, I guess, was it Frank? Is he the guy that was just a net holder?
He's the guy with all the dollars.
We agree. Why Frank? And again, it doesn't have to be like, oh, I dislike Donald Trump. It could just be like, wow, these are erratic. In which I think, let me just mention one other thing too.
Yeah.
I had thought perhaps this is just an inflation thing, like, because why is gold exploding and what? But no, I mean, to the extent that you think like the 10-year break-even inflation rate measure means anything, that's lower now than it was on April 2nd. You know what I mean? Like,
and Bob, look at CPI and PPI. I don't know if you saw that, but CPI month over month came in negative. We went from 2 point, not that it's an accurate measure, but I think the trend, it shows a trend. Sure. Then CPI goes from 2.8 to 2.4, and PPI was like negative 0.4 month over month. So years, and one of the main reasons we saw it go from 2.8 to 2.4 was energy prices, but that was energy prices from March. Think about what's happened in April with oil going down into the mid 50s. So if we continue out through April with oil down low 60s or even in the 50s, I think we could see CPI at like 2% or something like that for the next read. So anyway, my point there is going back to what you're saying with tips, is it's not likely that the market is seeing this as a big inflationary event, and that's why gold went up.
But right, yeah. So we're in agree. Yeah. So whether we're looking at like short-term indicators or long-term implicit market forecasts, if you want to use that phraseology, yeah, it's not like, oh wow, with all these tariffs, prices are going to go higher. And by the way, I do think in general tariffs make things more expensive. So I'm not. But my point is that to me, that's not what's going on here. That's not why gold's blowing up. Yeah. And so there is that element as well. So yeah, I'm open to the idea that it could be just a general, because also too, last thing I'll say on the inflation stuff, people like to point at Smoot-Hawley. Well, prices collapsed, in the early 30s, right? So say what you will about that. It's not that because of the Smoot-Hawley tariffs, everything was more expensive at the store. You can say relative to the counterfactual, and instead of prices falling by a third, they would have fallen by even more were it not for the tariff. But you get what I'm saying. So it seems like we're in a similar thing here where it's, these tariffs may make things more expensive relative to the counterfactual, but the very act of putting them in place seems to have triggered something. Yeah. So as far as your question, right. So we agree if some guy who's just net US dollar asset holder is spooked, he says, I want to reduce my exposure to the US market. He sells off treasuries or whatever, even stock in US. But yeah, he sells off, he has a bunch of dollars in his control. He wants to get rid of it and get into euros. That was pushed down dollar prices. So here's where I think I am trying to be conciliatory to you. I agree. The ultimate impact of his selling on the euro dollar exchange rate is mitigated by the fact that there are also a ton of Europeans who have dollar denominated debt, because especially as it gets priced lower, they might rush in and say, oh, let me pay off my debt now. This is a lot cheaper. I can go ahead and knock out my liens or whatever you want to terminology.
Just to be clear, if they pay off their debt, that reduces the supply of dollars.
Yeah. Okay. Yeah.
Because if it just for the viewer here. Right. So if Fred, which is who Bob is talking about, if let's say they have a loan for $1 million and they want to pay that off, to Bob's point. Well, what they do is they have to get $1 million in their checking account with the bank, let's say. And then the way they pay the bank is the bank simply reduces the liability side of their balance sheet. They don't increase the asset side. So what happens is they would just take Bob, Fred's account from $1 million down to $0. And those dollars are gone. They disappear. So the act of paying off the loan, all else being equal, reduces the supply of dollars because those dollars were just a commercial bank deposit liability.
Yeah, and so I agree. Yeah, the existence of that whole network of leverage out there, if that's the word you want to use, it's like a black hole that's going to absorb a lot of the attempts to get rid of dollars, and so on net, there's not going to be this whole flood of dollars returning to the U.S. and driving up prices at Walmart, which is kind of the metaphor a lot of gold standard people use. I probably talk like that myself. So I guess where maybe I think we might differ is I don't think you can tell a story where because there's, everything's going along, normal, there's a shock. Investors around the world want to reduce their holdings of US dollars. Mm-hmm. And then when the dust settles, it ends up the dollar's stronger than it would have been had there been no desire to unload dollars. So I agree the fall is arrested because of the stuff you're talking about. That as they're trying to dump dollars, there's a sense in which dollars are being destroyed. And so the supply is shrinking along with the demand. But I don't think it's like the supply shrinks by more than the demand. So you end up with the dollar being stronger than it would have been had there been no calamity. I guess that's maybe where we're differing. Yeah.
So the way I think about it, if I'm trying to, let's say, steelman an argument for the dollar actually going higher than it was to begin with. So in this case, let's say we start at 103 and we've gone down to 99. And so what would be my argument as to why the dollar would rip right back up to not even 103, but maybe 106? And let's say, 3 a month or two, something like that. So when those dollars are created, they're created with principal and interest. So there's actually not enough dollars to quote unquote pay the debt. So what that requires is velocity. You can pay off, let's say you have $10 in principal and then $10 of interest. That $10 of principal is what created the $10 that exist. So there's only $10 that exist, but you got to pay the $10 of principal and $10 of interest. Now that can be paid, but you have to have velocity. You have to have very, very high velocity of those $10 circulating around and around and around to be able to make those payments. So there's that. But then also when we look at the fact that the amount of loans in that case, in this scenario, especially when liquidity is tight, would be decreasing because foreigners don't want to deal in dollars anymore. Therefore, they're going to be less likely to take out dollar loans. So when you have a banking system where every single dollar is lent into existence, the only way that you can increase the supply of dollars is if you have more loans being created than are being paid off. So if we go into this scenario where foreigners are continuing to dump dollars, at a certain point, you're going to have the opposite. You're going to have more loans being paid off than are being created. And then what that does is that not only reduces the velocity of dollars, but that reduces the supply. So the supply of dollars is going down, 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 down. But remember, you have more, but there's still going to be dollar debt out there. But that dollar debt that exists still has the interest payments. So let's just say that we start with 75 trillion worth of dollars, and then foreigners start dumping and dumping and dumping. Well, that means that we go from 75 trillion down to 70, down to 65, down to 60. But every single time, let's just say now we're at 60, well, you've got 60 worth of principal, but then you also have another, let's say 10 trillion in interest. And so you're always in this back and forth dynamic. And then if you have velocity slowing at the same time, then that reduces the cash flow, that reduces the ability to pay the debt in the first place. And then it reduces the ability to roll over that debt in the future. So that's why I say, and then that exacerbates the problem. And that's why I could see the dollar going even higher, even if that first move is down, because those foreigners are dumping. Now, to be clear, Bob, if the debt wasn't short term, I would have a different view. So let's just assume for a moment that $75 trillion were created with like 30-year fixed rate mortgages. Okay, well now that's a completely different ballgame, because all of those foreigners, the foreigner Fred, they don't need those dollars for 30 years. Let's assume they have a balloon payment or something like that. So then you can have all this dumping and dumping and dumping and dumping and dumping and dumping, and there's no bid for dollars for 30 years. But what we have is this weird dynamic where they've got to roll over that debt every month, every 2 months, every three. It's very short term. So you think about, this problem with the United States having to roll over, let's say 10 trillion this year at a federal level. Well, I mean, the Eurodollars, I don't know what the exact number is, but the Eurodollar system has to roll over, let's say 50 trillion in debt almost every month. So how you see what I'm saying? So you can see how those dollars get absorbed very, very quickly, but then that leads to an environment where liquidity shrinks, velocity slows, and that makes the demand for the dollar go up even higher. And one last thing I'll say, Bob, just for the viewers, is the reason that the dollar does rip higher is because if cash flows go down, or another reason, because the only thing that those foreigners are going to have to satisfy those payments is the yen or yuan or whatever it is on their balance sheet. So then they're in a position where they have to sell those yen, they have to sell those yuan for dollars, and that makes the dollar go up even higher. So that's just, I'm sure you followed that. So what would be your pushback with that? And I'm not saying that I'm completely right.
Right.
I'm just saying that this is the way that I've kind of thought it through in my mind. So I'm just looking for people like you to say, well, I agree on this, I disagree on this, just so I can sharpen my thinking here.
Right. So again, just to state where I think we're in total agreement is we agree if dollars were just like $100 bills, U.S. currency, legal tender issued by, the Treasury or the Federal Reserve, whatever, the Federal Reserve note. And that's what foreigners were using. And there was no bank credit. It was just then clearly the fact that, the one guy is just saying, I want to hold fewer $100 bills and I want to hold more euro notes and was selling, that would push it down. And then somebody, and then somebody who did have debt, he did owe $1,000 to somebody, he would be like a backstop there. He would say, oh, wow, why don't I go ahead and knock this debt out while it's cheaper because, I earn my salary in euros or something. And so then he would just go ahead. So it would be a backstop. The existence of outstanding USD debt would be a backstop, like a shock absorber, but it wouldn't make it flip the other way. We're in agreement with that.
But just so I'm clear, just so we're clear there with the audience, that's all the difference in the world as far as dollars to dollars that were created with debt. Because let's say if I owe you $1,000 but you're not a bank, you're just Bob. So then I pay you $1,000 worth of green pieces of paper. You have those green pieces of paper in your back pocket. They didn't go away. Nothing happened to the supply of dollars. Right. They're still there. So if everyone is dumping dollars, then there's no bid. You're not going to reduce the supply. That's when you get into Argentina. That's when you get into hyperinflation because most of those dollars weren't lent into existence. But if let's say Bob is a bank and he lends me $1,000 and I pay him back, when he lends me those $1,000, he is creating new money. And when I pay that loan back, we are destroying that money. So it's night and day difference whether the loan is in, let's just say bank credit or whether the loan is in green pieces of paper.
Right. And to be clear, I wasn't saying I just blew you up. I was just making trying to show where do we part ways. Yeah. So I think we're up in agreement that, if it were literal $100 bills, U.S., the foreign institutions don't have the legal ability to create Benjamins, then that's how it would play out. And then now the issue, though, is there's like this accordion effect of Europeans who have dollar assets. A lot of what created those is not the Federal Reserve literally printing green pieces of paper. It's foreign, European banks and whatnot that are just making loans denominated in USD. Yep. And that's in the very act of granting the loan, and asset and liability on the bank's balance sheet goes up simultaneously. Okay. So I agree with you. Again, I'm going to say I agree that is an extra shock absorber. And now I think just where we're disagreeing is, could the effect that as somebody's paying off their dollar debt, that's simultaneously reducing the amount of European created dollars, through bank credit, is that? Well,
just to be clear, while at the same time, velocity of dollars is slowing. So it's harder to get that dollar cash flow to actually pay the bank. And therefore that's requiring that foreign entity to sell other denominated assets on their balance sheet, let's just say yen, in order to get those dollars to pay the debt, which then reduces the supply. It's not just the fact that they were lent into existence. It's also when you have velocity slow, therefore harder to get the cash flow, and then liquidity freeze to where it's harder to roll over the debt.
Okay, so instead of tackling you head on there, let me just switch it and see if you agree.
Okay.
To me, and this, we kind of had this argument a year ago, or I forget when, we were going back and forth with our shows. Would you say the same thing applies just the U.S. domestically, right? So most of what Americans hold in terms of dollars is not green pieces of paper. It's like their checking account balances. So that same process happens domestically. And so I want to say right now there's an equilibrium, let's say, and then for whatever reason, Americans in general say, I don't want to hold as much actual cash.
Yeah.
I want to get out of I want to dump the dollar and get into stocks or real estate or gold coins or something. And would you say by the same token, well, no, see, because if there's a guy who just has a checking account balance and no mortgage or car loan or credit card debt, he can withdraw $500, write checks and go buy some gold coins from Peter's, Euro Pacific Capital and whatnot. But there are plenty of other people who do have short-term debt denominated in Americans, and they're gonna get it, and as they pay off their debt, then that's going to shrink the outstanding supply of dollars as measured by M1 and M2.
Yeah.
And so therefore, would you say the act of Americans in general wanting to dump the dollar makes the dollar strengthen?
Yeah. It'd be deflationary. So like what or it would be, there's a lot of cross currents there, but that would be definitely a tailwind, I guess, to deflation or even disinflation. And that's, I think what we've seen since 2022, where if you look at M2, it's actually gone down. And so why has it gone down? It's gone down. One of the main reasons is because there's been fewer loans that have been taken out than have been created. You combine that with QT. QT is a big reason why. But that's, taking those dollars and then they basically disappear. So if all the United States citizens tomorrow said, you know what, screw it, we're dumping these stupid dollars. We're going to go ahead and pay off all the debt that created these dollars to begin with, the amount of dollars would go to zero. There would be, other than currency in circulation, of course. Outside of green pieces of paper, all the dollars, they'd be gone. There'd be no dollars. So that, in my view, would be pretty deflationary.
Okay. And again, last thing I'll say, and I'm glad you're biting the bullet there. So it, because the international stuff makes it trickier. But I think where you and I are disagreeing is just, we can do it in terms of the U.S. itself. But even there, like you were saying, M2 is lower now, but CPI is higher now than it was in 2022.
Yeah.
So I'm still saying that yes, the shrinkage of the quantity of dollars broadly measured certainly is a shock absorber to the process, but I don't think it actually flips it such that the dollar literally strengthens, right? The dollar has weakened against goods and services in the U.S., even as you're saying M2 in amidst QT.
Because you can have velocity going up there. So what we're doing there is we're assuming, let's just use the United States to keep it simple. I think that is a good idea. So if you had, let's say, U.S. citizens saying, screw this, I don't want these dollars anymore. I want to hold BRICS currencies because they're backed by gold or something like that. And then what you have is you have all these people, they'd have to pay off their loan, assuming it's short term again, right? So they would have to pay off their loans. And when they pay off their loans, the amount of dollars is going to plummet and the velocity is going to plummet and dollar liquidity is going to plummet because there's not going to be any banks that are going to be willing to loan because no borrowers want to take out dollar denominated loans. So when you have those three things, I don't see how, I don't see how prices could possibly go up in that environment. Now, if we're flat since 2022, why is the CPI higher? I think you would have to have velocity increasing. And I don't think we're at a point where liquidity has basically frozen in the United States as far as bank lending.
Okay, yeah, and we're actually converging that you're right, like just in terms of the accounting or the MV equals PY or whatever equation of exchange you want to use. It's got to be the case, that if M is shrinking, and we're using folks to be broadly including bank credit and stuff like that, not just green pieces of paper. But if M is shrinking, and yet we're saying prices are still going up, perhaps modestly, then you'd think what's going on? Oh, it's got to be that V has gone up.
Yeah.
But I'm saying right, and so in this. And I can see why, even as you're talking, you're almost convincing me. And I'm saying, no, because you're right. Other things equal, if all of a sudden the banks start calling it, they start contracting credit, like the managers are looking and they say, what, let's tighten up. I'm nervous about the future. Let's go ahead and start calling in loans or stop rolling them over, whatever, calling in shrinking lines of credit and whatnot. Other things equal, yes, that's going to have a contractionary effect. That's going to make prices lower than they otherwise would have been. Right, it's going to crush a boom that's in progress, that sort of thing. I agree with that. But again, what the thought experiment is, what if what's driving, what's starting the system to move is that people are trying to dump dollars. Well, what does that mean? That makes velocity go up, right? That's what it's like if, and like in the, classic hyper inflation in Germany, people getting paid and just rushing to the store just to get into goods because prices are going up so fast. So I'm saying, I agree with your analysis. I'm just saying, I don't see why, if ever there's a mad dash to dump dollars, that would actually make V measured in dollars go up as everyone's just trying to get rid of them.
Yeah, because the debt's short term. It's the whole key, because the debt's short term. So how much velocity can you possibly have if the debt has to be paid tomorrow? I'm just taking it to an extreme. You can't have velocity, right? So if you had, if let's say all the dollars that were circulating in the United States were created from a 30-year mortgage, then you're absolutely right. Mm-hmm. People are going to be dumping dollars. The velocity is going to be increasing. I mean, you're going to see hyperinflation, but it makes all the difference in the world that debt, just taking it to an extreme, is due in 2 days. Because if that debt is due in 2 days, you can only have the velocity of money circulate for 2 days before the money's gone. It's completely gone.
Okay, yeah, I get what. Yeah, because an analogy I use in terms of that issue of in a different context when people are saying, isn't there something weird about like if the bank lends $1,000 and then you owe $1,100 next year, but yet if that 1,000 was just created by the act of lending, like there doesn't exist 1,100 to pay it back. So isn't there some kind of thing?
Yeah. So what would happen? Let's just take that 2 day. My base case there would be that first day, the dollar would tank against goods and services. Let's say the dollar would collapse, and then the second day, the dollar would rip higher. Would rip. It would almost go to zero and then go to infinity the very next day.
Right. I get what you're saying. Yeah. So the way, yes, I'm going to end up agreeing with like the qualitatively with you. And then I think we're just arguing about the numbers and the specifics, but yeah, because the way I dealt with that was to, when someone was asking, does the universe implode if you ever got into a situation like that? And I was like, well, it doesn't need to. And I was like, it's goofy. You got two neighbors and the one neighbor owes his other neighbor 10 gold coins, but there's only one gold coin in existence. And it's a 10% debt, or interest rate, excuse me. And so it's like every week let's say it rolls over weekly. So every week it's like he owes him a gold coin as interest. And that is sustainable as long as like the one guy keeps mowing the guy's lawn every week and he gets him a gold coin up and then he uses it to pay the interest. And so you could just do that forever. And, and you're right that as long as there was enough in circulation that he could pay a little bit more than the interest, in theory, he could just whittle it down. And, if he,
but even in that scenario that you're explaining, I wouldn't use a gold coin and the reason I wouldn't use a gold coin is because when he is making the portion of his payment that he's making, that's principal, would actually reduce the supply of gold coins. Where if you're actually paying gold coins, then that would not reduce the supply of gold coins.
Well, sure. But I mean, also even in your thing too, like there are U.S., there are U.S. reserves, like either literal currency or, reserves on deposit with the Fed that are underpinning a lot of the, like the base of the pyramid upon which all the other stuff is built up.
Yeah. So this is a great point. So now we get it. So what we did right there, guys, is for that thought experiment, we completely excluded currency and circulation, just because we're trying to look at this through the lens of the vast majority of money that's outside of the United States.
Hey, George, can I just stop you one second? Because I was getting ready to agree with you. So I was saying, even there, though, to make my story work, again, where the idea was the gold coin was like the base money, and then the outstanding, like, oh, geez, I owe Fred, my next door neighbor, 10 gold coins, and let's say there's only 2 in existence, and suppose the weekly interest payment is 1 gold coin. And I was saying that doesn't mean it's impossible to pay his neighbor off because, hey, I owe him 10 and there's only 2. And I was saying because every week he could cut his lawn and babysit his kid and get 2 in income, pay that, pays the interest on the debt and then knocks it down by 1 gold coin. He could be paid off in 10 weeks. But you're right. Even my story meant the velocity has to be enough relative to the rate of repayment to make that all work. And then if the guy said, no, you owe me the 10 next week, and he can't possibly do 10 gold ounces worth of work in the week to earn income, then it doesn't work. So I agree with you, depending on the numbers. Yeah, the shorter term the debt or whatever, that could cause an issue.
Yeah, that's when I first started thinking this through, that's why I got really focused on how short-term or long-term is the debt that created these dollars outside of the United States. So there's no way, unfortunately, you can't get this at the IMF or the BIS or anything like that. So you have to kind of just, look at all of these different statistics and just kind of use some common sense. And the conclusion that I came to is, the vast majority is under 6 months. And I think, and the biggest percentage of that is under 3 months, because so much of the debt and so many of these dollars are just interbank. It's interbank stuff, and then it's huge corporations just borrowing for a month or 2 months, commercial paper and all these things. So that's the key. That's the absolute key for sure. And just to provide some more nuance, guys, if all the debt was paid off tomorrow, let's say in the entire world, there still would be dollars that exist, to be clear. Those green pieces of paper are still going to exist, right? So you got to look at currency and circulation. Now, there also would be some, let's just say M2. Well, there would be some commercial bank deposit liabilities that would still exist. How? How is that possible? Because of what Bob was talking about with the Fed's balance sheet, right? So let's just say that the Fed purchases a treasury from a non-bank entity. That process increases the amount of M2. And it did it without lending it into existence, without a bank lending it into existence. So if we pay off all the debts tomorrow, you're basically going to be left with the amount of currency in circulation, and you're going to be left with maybe half of the bank reserves. Why half? Because I'm just assuming that 50% of the Fed's purchases of assets were from bank entities, which actually does not impact M2 money supply. So that's, and that's getting into the weeds for sure. But I think that's the only that's what you're going to hear on this channel, and you're not going to hear anywhere else. Hopefully that's why we're adding some value here, Bob.
Yeah, another way of saying that, restating the point you just made is, besides there just being literal US, $20 bills, $100 bills, legally speaking, that's equivalent if somebody has a reserve account with the Fed, right? And so like Citibank or whoever, or the US Treasury, they basically have like a checking account at the Fed, and that is as good as literal currency, right? Whereas if you have $100 on deposit at Citibank, that's not legally indistinguishable from a $100 bill. Whereas Citibank has $100 on deposit with the Fed, that's literally, and if Citibank said, I want to withdraw it, and the Fed didn't have it on hand as paper, they could just print it and say, okay, there you go. Right. Whereas, Citibank's not allowed to legally print US currency. So there's that element that kind of is underscored. And I guess, so I think we're largely in agreement in terms of the qualitative stuff. I guess I would just say, George, I agree with you. The short-term dynamics, depending on the maturities and blah, 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 and went and simulated it. It could look, it wouldn't just be a smooth thing like, oh, foreigners decide to reduce their holdings, and so the dollar just gradually falls off a cliff. There could be all kinds of jagged stuff. And then that volatility itself would cause more uncertainty, and who knows what the hell that would do.
And liquidity would freeze. So then it's harder to get dollar debt, which reduces the supply even further. So I think, we've really gotten into the weeds, guys, and hopefully you can appreciate that. I know I love these conversations. But I think if a lot of the viewers are saying, okay, what's the main takeaway here? the main takeaway is, if you're looking at the DXY and what it's done, I think we both agree that it's highly unlikely, due to the dollar denominated debt, that the dollar relative to these other currencies just absolutely crashes. That's very, very unlikely. I would say it's almost impossible. And there is going to be a bid for sure. Now, is that bid going to be at 90, at 95? We don't know, but it's probably not going to be at 70 as far as the DXY. And where Bob and I differ is, Bob would say, okay, it could probably, if the bid is at 90 based on all the dollar denominated debt, my base case is it kind of stays around 90. And then we kind of fluctuate from there. And that's kind of the new benchmark, if you will. Where we see things a little different is, my base case would be wherever it started, let's just say at 103. If we get down to 90, within a couple months, it would most likely go back up to that 103 mark. Or at the very least, the dollar would have a lot of tailwind because of foreigner Fred. So that's kind of, I think, the main takeaway in regards to the dollar for the audience. Bob, do you agree with that?
Yeah, I would just say, yeah, my view is right. I don't think it's going to just fall off a cliff because there are all those, call them shock absorbers or obstacles in the way to cushion the blow. I don't necessarily think there's going to be something that's going to make it snap back. And for one reason, I would say ultimately, yeah, if by assumption the dollar is originally falling against other currencies, and then you say, well, so where are they going to get it from? So ultimately, they could get it from the U.S. Like they could just get Benjamins. Someone could put them in a briefcase and UPS them across the ocean if they absolutely had to. So I'm saying, given that the dollar weakens a little bit in the beginning, I could see a mechanism that they still can make those payments and so on. But I agree with you. You would have to get pretty specific and so big picture for me. Yeah, I don't think it's going to fall off a cliff, even if things continue to deteriorate with the trade deals and blah, blah, blah.
Yeah.
But yeah. I don't necessarily see it spiking back above where it was at the start of the year.
Okay. Yeah, fair. And I would like to remind the audience, we had, and I didn't even know this, but I did some research the other day for a video, and we have seen this happen before, believe it or not. So the good news is it's not unprecedented. And what I'm talking about is not just the move down to 99.5, but the dollar dropping so quickly. And, Bob was talking at the beginning of the video about how treasuries of the 10-year is now like 4.4. And it's like, it's not that big, or it's not that high. But the shocking story there was not the level it is now, but how quickly it went there. And on Monday, Bob, I was following the market quite closely, and intraday, the 10-year treasury had like a 35 basis point move. And I mean, that's whoa, time out here. That's not supposed to happen.
Right.
So the good news is we have seen that happen before, where the dollar's crashing, yields are spiking with massive stock market volatility. That's the good news. The bad news is I have only found this in times where the stuff's hitting the fan. So March of 2020, you saw something like that with off the run treasuries, just ripped higher. I think that was in large part due to the basis trade as well. And then the Fed had to step in with QE. But you saw the dollar actually go down quite heavily there. And then it, rips higher with that stock market volatility. And the exact same thing happened in September of 2008. September to October, you can find the dollar going down heavily, yields spiking, and they're really volatile, by the way, and then huge volatility to the downside with the stock market. And what's funny is what stopped that both times, Bob, was QE. It's when the Fed waves the white flag and says, and mechanically, I don't think that really does much, but just psychologically, the market's like, okay, we'll go ahead and provide liquidity now from all these banks. And then you actually see what you would have expected to see at the beginning, with the dollar ripping higher and yields just plummeting. So we'll have to see how this plays out.
That is funny. It's like someone has a gunshot wound and someone's like, don't worry, I've seen this before. And it's like, yeah, the guy died, but yeah, I've seen it.
Yeah. All right, buddy. Where can people find out more about what you do?
I would point them, I guess my Twitter account's been hopping lately. So that's at Bob Murphy Econ. And my day job is at Infinio, where we're tokenizing life insurance. So that's at infinio.ai.
And can you do a shout out for the podcast?
Sure.
Because and I've really enjoyed your tariff podcasts. I know you've done about 3 of them. I've listened to each one intently, and I would highly recommend them to the viewers.
Appreciate that. Yeah. So I host, it's called the Human Action Podcast at the Mises Institute. So you go to Mises, which is mises.org. And then the podcast is the Human Action Podcast. Yeah, thanks. I've done some deep dives with charts and things that I'm trying to show both sides are missing something.
Yeah, and you did a good one on the Infinio YouTube channel as well.
Okay, yeah. So infinio.ai, you can see the podcast there too.
Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow Rebel Capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets. And I will see you in Orlando, May 23rd through the 25th.